Guys, what's going on? This is Evan from the Swing Trade Pros team here, and welcome back to the channel, the #1 place for new and advanced traders. In this short video, I'm going to explain to you guys what call options are and what put options are, and the risks associated with them, and how you guys can really profit trading options. All right, guys, so briefly, real quick, I'm going to explain to you guys what options are. So credit to Investopedia. Options are financial instruments that are derivatives based on the value of the underlying securities, such as stocks. So basically, every single time you buy an option, you're buying a contract between a buyer and a seller, and you have the option to exercise that option, which means towards the end of your options expiration, given you have the capital to exercise the option, you can actually convert the option into shares. Okay, but most people, most traders do not exercise their options. What they end up doing is they sell before the option expires. So there's two types of options that I want to teach you guys about tonight, and two different strategies that we're just using. It's just basic, right? We're betting on the stock price going higher, which are called call options, and we're going to also be explaining about what put options are, which is betting on the stock going down in price. So when you get to purchasing your option, you're going to see what's called a strike price. And a strike price is the target at which you want to either buy the call option for or the put option for. So let's just say AMD is $50, okay? Basically, if you think that AMD is going to go up in price and you don't want to bet outside of the money because of time decay, let's just say, basically what you would want to do is you would want to buy an in-the-money call. And let me just pull up Yahoo Finance for you guys real quick here to give you guys an idea of what I'm talking about here. So we're talking about AMD in this example, and today AMD was down a little bit, right? It was down about a percent. So if we look at the options, okay, we're talking about call options right now, okay? So in this particular case, if we bought in the money calls, which means the stock price is within this range of the option strike, right? So, the $52 calls, the $51, basically, you're not betting on the stock going outside of the money. You're basically betting on the stock staying within this range, and it's more of a safer bet, because what will end up happening is the theta, which is maybe another lesson that we can talk about, but the theta on these options won't decay, right? So there's like a curve for time decay with options. Most options will expire worthless. That's just the probability of them. But what you want to do is you want to obviously time as much of it right as possible. So if you don't know where the stock's headed, but you know the stock's in an uptrend, you probably want to stick to in-the-money calls. Now, if you know that there's going to be a big breakout, or there's a catalyst, like a news-driven catalyst, like an earnings, or like maybe some big news about AMD, maybe you should take a higher risk trade and buy an out-the-money call. Now, the out-the-money calls obviously have a lot less premium, because probability-wise, at that current price, it's not as probable for the stock to reach that price, unless, of course, you have an inkling and understanding about where the price is headed, right? So one option contract, let me just quickly explain this. One option contract is equivalent to owning 100 shares of that stock. So say you think AMD is going to go to $55 by the end of this week. Okay, so if you think that, maybe you should look to buy $53 or $54 calls. Reason why I say not 55 strike is because you would need, at current market, you would need AMD to get to $55.19, which is the current ask for this call option at this strike. So to break even, you would need AMD to get to $55.19, right? So if you bought in a $53 strike, you would need AMD to get to $53.75. Now, that seems more likely because the price right now is at $52.75. Now you have on this particular option, you would have a couple days for AMD to get to your $55 target, but you really only need AMD to get to $53.75. So obviously this seems like a higher probability chance than getting to $55.19. Hence why the option premium is basically almost triple, right? Because it's more likely. Now, the further out you buy with these options, okay, so now let's just say we went to like a month out on AMD, right? And we bought the same $53 call. It's like 5x more expensive. And the reason being is because you're buying more time. Time is your friend with options, guys. By the way, make sure you guys hit that like button if you guys haven't done so already. Click that subscribe and tick the little bell if you guys like the content here. And we're going to get into the put options here real quick. But just a quick overview. An option is equivalent to owning 100 shares of the stock. The option premium is basically the price times 100. So currently, this $2.50 per contract at $53 in the money call is $250 per contract. Okay, so it's the same thing for the puts. However, the puts are a lot more implied volatility because the stock is much more likely. A stock drops a lot faster than it does go up. So the option premiums on puts are actually going to be a lot higher. Okay, so look, the $53 one was 2.75. So actually the spread is kind of close right now, right? But the $53 is in the money. So technically, if you want to compare the same, you'd be looking for outside the money, which would be at 255. So actually the puts are technically cheaper right now, which makes me inclined to believe that maybe there might be a move to the downside, which is what we got today. We got a little bit of a move to the downside. So the theta works the same way in that if you buy an option that's outside the money, it's going to obviously decay a lot faster. And decay just means it's going to lose value a lot faster than if you bought an in the money put, right? In the money just means, okay, I'm short the stock from 60 bucks and it's at $52 right now. It's very unlikely for it to go back to 60 bucks right now. So, you know, this option isn't going to lose value as quickly as, you know, something that's outside the money, meaning it hasn't got to that target, that range yet. All right, guys. Well, if you guys like this content, make sure you guys hit that like button, tick the subscribe, and click the little bell. And we'll catch you guys in the next video.